You sometimes talk about the upside down days for hedge funds, and that this doesn't happen often, but it does happen occasionally. Can you talk about portfolio construction from a portfolio construction perspective, how to actively risk manage those scenarios?
Well, first thing you'd look at is crowding. So if you were to have access to it, you'd look at the JP Morgan, Goldman Sachs, or Morgan Stanley prime brokerage reports, which I look at. And you just see where their positions are, right? So if your position is the exact same position as the consensus hedge fund positioning index, and or the portfolios or ETFs embedded therein, then just know that and have a hedge on it, right? So have the opposite, have puts, whatever. But there really is nothing. It's an interesting question because you're like, I don't want to be like taking the pain trade like with a bunch of hedge funds. Generally speaking, with the Hedgeye longs and shorts, you're not. We are so far away from the consensus pain trade that I can't get any further away. How many hedge funds are getting on CNBC or the Bloomberg TV or talking in the Wall Street Journal about being long the United Arab Emirates, corn, and IVOL? Zero, right? So the real way that you get away from it, as opposed to just trying to think about it, which is fine, is to actually do what we're doing, because we're the antichrist of consensus hedge fund positioning. Therefore, we very rarely, face the pain trade. It's not to say that, something like uranium, which is a crowded one, blows up that we can't start wearing some losses, which we lost some of our gains, but we got out of that. So that's the whole thing. The hedge fund community is still long uranium in the ETFs. Those things have been terrible, right? I've had different guys send me, oh, you'll be back. Don't have to be. There are a lot of different ways to answer that question. One question for myself that I didn't hit on, apologies in advance for that, correlation risk. Okay, so let's show the correlation table today. And what you can see is actually the explicit impact that oil has and that gold to some degree likes that is associated with a faster breakout in inflation. Okay, so what you're seeing here now is that the dollar and it's a 30-day, right? 30 days or more, definitely the machine cares about that. So what's happening here is that the market's saying, okay, if inflation go up, because this is inflation, if inflation go up, USD go up together, because that's hawkish, right? But not everybody gets paid in the very immediate term on stocks. They get the opposite of that, which is exactly what you're seeing this morning, that correlation hit, versus the prior, where strong dollar was fine. See that? So this flip in here is a thing. It's a very short-term thing. Can it resolve itself? I don't know. I don't have to answer that question. I just have to do what it's doing. But hopefully you notice that. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.